Hello everyone and welcome back. My name is Greg Furman and this is the Forex Weekly Outlook for the week of July the 31st, 2017. Now, as we begin the new month, the dollar is clearly under pressure, which is what I've talked about here over the last several months, but more specifically the last 3 to 4 weeks. The dollar has really come under some very heavy selling pressure. Now, when we look at the swing lows here, I talked about in last week's Forex Weekly Outlook that this area really did need to hold down around this 93.50. So as we zoom in on our VantagePoint charts, we get a better idea of what's actually going on here, particularly over the last 3 months. Now, once again, the dollar has really been hit. We can see that the main sell-off started back here in the beginning of May. We had some retracement areas, but nothing significant, only to repeatedly fail at the key VantagePoint 18-day predicted moving average. Now, this swing low here, price action traders will be watching this area. It's possible the dollar could get some relief on a positive non-farm payroll number coming up on Friday. That's the main event risk this coming week. But the indicators here from VantagePoint, as I've talked about, are in grossly oversold territory. Yet the dollar continues to move lower. So our main indicators are yet to give us a buy signal here or a reversal on the dollar. So the safe play for now, at least until we get the payroll number on Friday or the ADP report on Wednesday, is to keep selling US dollars. Now, when we look at the euro this week, once again, we've had a very, very good rally here over the last several months based around the VantagePoint indicators. Are we moving into heavily overbought territory on the indicators? We are. That doesn't mean here, guys, that the euro cannot go higher. There's very little reason to sell euros right now because there's very little reason to buy US dollars. Basically, that's what Forex trading is. So when we look at these key indicators, yes, we're overbought. That is always a concern. So I don't expect any big move or next big leg up in the euro until we get that payroll number. So for now, we're still remain buyers on dip. The key VantagePoint level 115.47, 116.44, followed by 117.11 with a very bullish close of 117.45. So if the dollar is in a long-term reversal and the dollar is going to go into a longer-term bear cycle, which is what I've been talking about for the last 3 months, then the euro is going to go into a longer-term bull cycle, probably heading back towards that 130, 140 area in the months and years to come. So right now, again, I would look for the range this week to play between where we've closed at 117.45 and we could come down as low as 115.47, where we're likely going to see buyers come right back in. Now, when we look at US Swiss franc, basically it usually mirrors Euro US, but the Swiss franc has moved higher, which is very, very strange. In my respectful opinion, we should probably be looking at selling into rallies still. Now, we do have a triple EMA cross, but once again, money is likely to move back into the Swiss franc in a risk-off environment, meaning that if all global equity markets continue to move lower, the Swiss franc, the yen, these currencies will gain strength. Now, as we come into the British pound for next week, once again, I've talked extensively about this pair, that I feel that the British pound is grossly undervalued. I would say that the market would tend to agree with me here that Brexit is not a big deal. It's actually a very good thing for the UK. Again, only in my respectful opinion. So when we look at the key VantagePoint level coming up for next week, we're looking at the 130 level. That is our key VantagePoint 18-day predicted moving average, where we would be buyers down to this particular level, followed by 130.60 and 131.01 with a very bullish close of 131.34. Now, our neural index is up here. Our main indicators are predicted short, medium, and long-term differences, how we gauge the strength of the trend with the VantagePoint indicators. They're all pointing higher here, guys, after we had this corrective move this past week back down to that 18-day moving average. So our predicted MACD is sitting in a fantastic area for further longs, as is the predicted RSI. But remember, we do have the non-farm payroll and the dollar could see some relief. However, The dollar usually, if we're going to see any relief in the US dollar, it's likely, guys, not going to be until probably mid-September. So I would remain a buyer on dips. We know the key levels here, and the main indicators from VantagePoint are suggesting we are going to remain stable with a bullish trend in place. Now, as we come into the US Japan, basically I've been calling shorts on this for weeks, guys, and the key thing we want to look at here is this triple EMA cross from VantagePoint, which is a leading indicator, the 3-day crossing over the 8-day and the 18-day predicted moving average. We can see that our short, medium, and long-term predicted differences move lower, the crossover on the predicted MACD, but the break of the 40 level on the predicted RSI really did set off a trigger. Now, what I want to point out here too is that we've retraced exactly to the key VantagePoint 18-day predicted moving average at 111.93 this week. We've hit that level, and your more savvy traders will be looking at that level and saying there is a fantastic short opportunity based around the VantagePoint indicators. We're crossing the 0 line on the predicted MACD. We are firmly below the 50 level on the predicted RSI and breaking below the 40. There's momentum building. That trade led from a move from 113 all the way to where we've closed at 110.62. So basically, guys, the dollar yen is highly susceptible to the non-farm payroll announcement on both Wednesday and on the main announcement on Friday. The ADP report has been pretty bad lately, so I wouldn't put a lot of money on ADP. That's the next best guess to what that number is going to be on Friday, but I would stick with selling rallies as the global equity markets, which I'll point out VantagePoint has done a fantastic job calling these the global equity markets moving lower. We currently have a minor sell signal on the S&P 500, so as long as those global indices are moving lower, that supports the VantagePoint indicators. The key intermarket correlation, equities down, dollar yen down. So we would remain sellers here, guys, and look for a move back towards 111.93 on a retracement basis pre-non-farm payroll, and then we're likely to move lower yet again. Now, as we come into our main three commodity currencies, the CAD, the Aussie, the New Zealand, they're all very similar trades here, guys. Very similar. US CAD down, Aussie US, New Zealand US up. So the key VantagePoint level 126.73, 125.37, and 124.79. Very bearish close yet again at 124.32. Now, when we look at leading indicators here, once again, guys, the main triple EMA cross from VantagePoint has happened way back in May. On those shorts, we've had multiple retracements back to that 18-day predicted moving average, multiple opportunities to get short again, even using the VantagePoint 8-day predicted moving average as a pivot area. All of that has led to a big move down. Our neural index, I can't remember when I've seen the neural index down that many days in a row in a heavily oversold condition. So this just goes to show you guys, just because something is oversold, it doesn't mean it can't move lower. The neural indexes remain lower. The market has remained below the VantagePoint 18-day predicted moving average at 126.73. There's just very little reason to be buying this particular pair. However, nothing goes straight up and nothing goes straight down. So please keep that in mind, that there could be opportunity coming here. Now, a lot of this big move has been based around the Bank of Canada rate hike. I've been a strong proponent that that was a mistake, and that mistake will have to be corrected by the Bank of Canada. We can already see a more dovish Fed coming into play here, and I believe that the Bank of Canada is not only going to be on hold, but we could be looking at a cut again sometime next year. Now, as we move into the Aussie and the New Zealand currency, you can see this tight wedge that I've talked about over the last several months, and when we break this level, we buy. So on this triple EMA cross from VantagePoint, it sent the Aussie higher, but we've had a lot of very big moves here in the Aussie that have been forecasted here. But the thing we have to remember is that, you know, going into the non-farm payroll, gold is likely to move a little bit lower. The commodity currency is likely to move a little bit lower as money repositions itself ahead of that. Some will still bet on the US dollar going into this, and they will bet against gold. So it's going to cause money to be shifting back and forth, but it doesn't mean the primary trend up in Aussie US hasn't changed. I believe that there's a bigger trend shift here back to the upside. Potentially we could possibly have bottomed out here for 2000, and not just 2017, but for the next several years to come. Like I've said, Aussie has been in a bear cycle here for about 6 years. Guys, that's probably coming to an end here very soon. So when the dollar makes its bigger, broader turn down, and don't think the dollar doesn't have more room to the downside, because it does, when that happens, gold is likely to go higher. Your commodity currencies are going to gain strength again. So right now, that key vantage point level, 78.46, I absolutely think we could see a retracement down to this level pre-non-farm and maybe even post-non-farm payroll. But this is a buying opportunity, guys, for us. So what we will do is we'll keep an eye on these indicators. We are absolutely overbought on the key. One of my favorite Vantage Point indicators, the long-term and the medium-term predicted difference. You can see that it crossed over right here as a leading indicator as we started to top out, and we've had a little bit of a move here on this one bar above it, but ultimately this signal is very, very accurate. Another very powerful tool inside the program to be using in your trading is the medium term crossing over the long term predicted difference in the opposite direction of which the market is doing. So the market is buying, and I'll point this out again because it certainly is worth a look. You can see the medium term trend forecasting back down as the market is advancing higher. That's a warning sign that we are probably getting ready to correct, to move lower. It doesn't mean that the trend is over here by a long shot, guys. It just means that, again, nothing goes straight up and nothing goes straight down. So look for your buying opportunity this week between 79.37 and 78.46. Now, New Zealand, again, I'm not going to spend a lot of time on this, guys, because I think you know what I'm going to say. It basically is an Aussie-US trade. So New Zealand has been very strong, very similar wedge formation that I just pointed out in the Aussie-US. We've broken through that. Myself with my own direct clients, we have been an immediate buyer at this. What most people will not do, they will not buy high and they will not sell low. With the confidence in the VantagePoint software, we can do these things when we're drawing in basic trend lines and identifying when price action, when the market is getting ready to buy something, guys. You either jump on the train or you get left behind. Is the unfortunate analogy that I use so often. But we really do want to look at this right now. That New Zealand's had a big move up, 73.79, the key Vantage Point 18-day predicted moving average. The further we move away from that, the more likely it is we're going to retrace to it. So if there's going to be a retracement, it will likely be this week, where again, any move down to 73.79, we would absolutely be buyers in this particular case.